I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuning in to Traders Nation. Thanks for staying with us. My pleasure to have with us here today Michael Eastham, book author of Common Sense Income Strategies. Michael, welcome to Traders Nation. How are you today?
I'm doing great, Kurt. Thanks for having me on.
Good. Thanks for being here. Appreciate it. Hey, what's the best approach for common sense when it comes to investor needs to fact check Wall Street? What do they need to do there, Michael?
Yeah, it's a great question. One of the things that I try to do in the book is to try and help people to, especially baby boomers and folks who are retirees, to trust their gut more often. Common sense means that when you think about what is a gut level decision, it's really the culmination of experiences that you've had over your entire life. Sure. And what we do is to help people to realize that you can invest more conservatively for interest and dividends without taking as much risk and generate enough income to live on comfortably in retirement. And that's one of the things that we try to do in the book.
Sure. Would you say the best approach, to at least to start off, is to go on the conservative side? And of course, that depends on age, doesn't it, when it comes to putting your portfolio together for retirement?
Sure. Age does have a fair amount to do with it, because the closer you get to retirement, then you have to realize that when you step into retirement, you're going to be letting go of your salary. Yeah. So your income source is going to go away. That means you have to replace it. And Social Security was never designed to be the sole source of income in retirement. Fewer and fewer people have pensions. That means that they need to look to the savings and investments, IRAs, 401ks, that they've saved up over their entire working lifetime as a replacement source for income.
So safe to say, if you're younger, 20s, 30s, you can be aggressive, really kind of pour it on. But as you're 40s and 50s, really got to start pulling some of that back and start looking at some income investments, correct?
Yeah, of course, the younger you are, the more able you are to live through a market correction, a major market correction, and we've had a couple of them in the last 15, 16 years. But if you're in retirement or you're close to retirement, you don't have that luxury. If you're a year away from retirement and you experience a 30, 40, 50% drop, then that's going to have an impact on your retirement goals. But if you're 20, not so much. You've got time to recover, and you've got your dollar cost averaging in because you're saving and buying in at lower prices, and that can help you over the long run while you're growing your assets. Not so much. It has the exact opposite effect if you're taking money out of your portfolio and the market's going down.
So let's say somebody's retired or close to retirement. Certainly they're going to be very conservative, right? They want to conserve or they want to maintain what they have because they're preparing for a retirement, Michael. So what should they do? Because CDs, interest rates are all-time low.
Right.
Where's the income going to come from? You got safety there, but does it pay? Where's that balance for older folks?
Right. Yeah, another great point. There's a whole spectrum of income-based investments. I refer to it as the universe of income-generating investments, and things from individual corporate bonds, not bond funds, preferred stocks, business development companies, REITs, annuities. Those things can all provide replacement income on a predictable level. Okay. And in many cases, you're reducing your risk dramatically from just traditional mutual fund or common stock investments. And even bond funds, because as I mentioned a minute ago, if we have a client who does want an allocation in bonds, then we buy individual bonds because of the contractual guarantees that you have. A bond fund, all bets are off. It's very similar to a mutual fund or a traditional mutual fund. You don't have any of the contractual guarantees.
Sure. All right, so not all advisors are created equal. How can somebody, if they're looking, they want to invest, they want to put money away for their retirement, but, they're not savvy. They work hard. They do all these things. They do all the things right? Raising their family, things like that, but they're not savvy on the investor side. So how do they find a good advisor, somebody that they can work with?
Yeah, and actually that's an excellent point that I address in the book.
Sure.
I mean, I would encourage folks to read Common Sense Income Strategies because we do talk about what are some of the questions that you want to ask of your advisor. I mean, what's important in selecting an advisor? Is he a fiduciary, or are they paid a commission based on transactions? So, or are they paid for managing the assets and providing advice?
Sure.
Does he have a fiduciary obligation? Do you typically invest in mutual funds, or do you purchase individual securities that are designed to generate interest and dividends? Those are some critical things, and really I'd encourage folks to read the book, because there's a pretty good map laid out for folks who are just like that in Common Sense Income Strategies.
So there's a lot that goes into that, and it's interesting because you're going to have history, which doesn't mean what the future is going to look like, performance from that advisor. And one thing that really kind of hit me in the head was you said fees. I mean, is there certain things that people should be looking for to stay away from, or what would be in the favor of finding a good advisor?
In terms of fees, you mean?
Yeah, well, I mean, you mentioned fees. I mean, I know.
Yeah, sure.
Yeah, for instance, like trading, like transaction fees. Because I know that I know some folks, not all, but some folks will do a ton of transactions because that's where they make their money. So I guess my point.
Yeah, you don't. That's why you want to make sure that if you're working with a financial advisor, make sure that they're a fiduciary. Make sure that they're obligated professionally to make investment decisions that are in your best interest as a consumer.
Yeah.
There are too many guys that are out there that are just sales guys, and there's nothing wrong with that.
No.
It's just that they don't necessarily have a fiduciary obligation. That's where a lot of the transaction costs really impact your return. They're more buying and selling all the time, whereas developing a plan, developing an income strategy that involves many different investment vehicles, using a financial advisor who's a fiduciary, that is really going to be a benefit to someone, because you know that relationship's going to be built for the long run. It's not just, hey, let's see if you can find the next Microsoft.
Sure, right. So I think fiduciary is the key here. All right, so let's move on. The political arena, turbulent, right? People with their portfolios, should they be concerned about the political environment that's going on in D.C., nationwide? Politics kind of do have an effect on the markets, for instance, the tax bill, things like that. So should people be concerned about the political environment in the arena?
Yeah, I think especially now you have to have a close eye and even a skeptical eye on the political arena. The market's at an all-time high.
Yeah.
And this is something that I tell people quite a bit. There's a lot of momentum on the tax changes and the likelihood of sweeping tax reform. I do believe that it's going to benefit the economy and it'll benefit the stock market in the short run.
Okay.
But I think right now people have to realize that when is the best time to sell, or when is the best time to reduce your risk? When the market's at an all-time high, that's a great time to take some gains off the table. But you also have to consider, well, how are these things going to affect me from a tax standpoint? And that's one of the things where corporations, I think you're going to see a big jump in corporate profits. So there's going to be some momentum in the market right after tax reform gets signed by the president.
Yeah.
But at the same time, the skepticism needs to come in, because you have to ask yourself right now, at 24,000, approaching 25,000 on the Dow, is some of that optimism already baked in to the prices, to the prices of the stock market?
Sure. All right.
And could there be a turnaround?
All right, we're out of time. Hey, Michael, where can we get a copy of Common Sense Income Strategies today?
You can go to fellowshipfinancial.com. That's our website, fellowshipfinancial.com. Okay. And just click on the link.
Head on over there today. Hey, Michael, we do appreciate your time here today. Common Sense Income Strategies, Michael Eastham. Get a copy of his book today. Head on over to that website. We'll be right back. Stay tuned.